We've got lots to talk about. Let's begin.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Okay, this is episode 482. I have cue cards for those watching on YouTube. Ted does not, because he does not know what the topic is. We just said, let's just
surprise, surprise, surprise.
So the topic is the annual checkup. Okay.
Whose annual checkup?
Well, we're going to talk about that. So, and I'm actually kind of proud of us because we are recording this at the end of November. We've managed to avoid talking about Financial Literacy Month. I think we might have mentioned it in one episode at the beginning of the month.
I'm pretty sure you just mentioned it right now.
And there I just mentioned it. And because I am, of course, of the view that it's largely a waste of time. It's a government program.
Wow, it's a marketing thing.
Isn't particularly practical.
So make the people that make money off it.
Exactly. So what we're going to do today is just entirely practical advice. We're just going to start with the practical advice section of the show.
Okay.
And it's not going to be the obvious stuff like you should spend less than you earn. Well, yes, we all agree with that. That's motherhood.
Talk to the barber.
There you go. And there's lots of videos on all that stuff. So people can go in.
That one's covered. We're going to talk about stuff that people don't normally talk about.
Other stuff. And I think you actually made this comment a few shows ago that, once a year you should go through everything and just make sure that you're up to date on stuff.
Self-assessment. You're calling it something else.
An annual checkup. But self-assessment, that's good too. And of course, you can do it more than once a year. You can do it as often as you want. I'm a big believer in doing it at the start of the year, New Year's Day. You got nothing else to do anyways.
Or do it on the trick is to do it on a regular enough basis that it has some usefulness.
And so you're a birthday guy. That's when
do stuff on your birthday.
Now your birthday's towards the end of the year, so it kind of makes sense as well. So you're right. Pick a time. Be consistent with it. It's like changing the things in your smoke alarms.
Teach your spouse and children to do it. Good luck with that.
Everybody will do it. Okay, so the first one, I'm going to start with the obvious one, and I just said that we're not going to do any obvious ones, but I'm going to start with the obvious one, and that is you got to review and update your will.
Yep.
And you should do that anytime there is a change in your circumstances.
Anytime there's a significant change, you got to define what that is, I guess.
Yeah. So you get married, you get divorced, you have a kid, something like that.
Right.
You have a significant new asset, you bought a house, something like that, then that would require a change. And I think it's obvious why that's necessary.
Sure. If
you don't own anything, I guess it doesn't really matter. But if you do own something, you want to be deciding what happens when you're dead.
Well, and not only that you want to be deciding, you don't want to force the courts to decide.
Which is even worse.
Because if there is something that can be fought over, the fees will eat up the whole damn thing anyway.
So make a plan in advance. Now, there are two offshoots to that, which are powers of attorney. Mm-hmm. Power of attorney for personal care and for property. What does that mean?
So the power of attorney for personal care deals basically with your medical situation. So if there's something going on and you are incapacitated, you're no longer responsible or I don't know, what's the word I'm looking for?
Capable.
That's a good one. If you can't make your own decisions, it gives somebody else the authority to make them for you, which makes sense.
And the power of attorney over property is same kind of thing, except it deals with your property.
That's right. So again, for whatever reason, they've determined you're not capable of dealing with these decisions, and now you've delegated that responsibility to somebody else.
So I've moved into a long-term care home. Someone's got to sell my house. That would be property.
Well, and so both of these power of attorneys are things that you should look at while you're still competent. If you leave it till after the fact, then there's always somebody who could say, well, wait a minute, grandma wasn't competent when you did the power of attorney, and then the fighting can start.
Yeah, and I'm a believer in talking to a lawyer about this. I mean, I know there's online forms you can get and fill them out yourself. If there's any kind of assets that you've got, probably better to get it done right. The insurance, the powers of attorney, or the will and the power of attorney, you're good. Right. Okay, so I said we wouldn't spend a whole lot of time on that because it is an obvious one. Item number 2 on my list, insurance.
Right, that's an interesting topic.
There is, and I got a few different categories. So let's start with the obvious one, life insurance.
Okay, and how many different categories of that are we going to talk about?
Well, you tell me what pops into your mind when I say that.
So you've got whole life insurance, you've got term insurance, and then you've got the hybrid, which is, I'm trying to remember what the hell it's called.
Whole term insurance, I don't know.
There's another name, but it'll come to me while we're talking, I'm sure. So whole life insurance is basically you're accumulating value in a savings account that is added to whatever insurance coverage you've purchased. So The advantage of this type of policy, or the reason they were created in the first place, any growth in that savings account is non-taxed. And when you pay the money out at the end of when whomever gets the insurance benefit, it's not taxed at that point either.
And if it builds up enough value, then, well, maybe you don't have to pay into it once you hit age 60 or 70 or 80 or
whatever the plan is structured. And the term insurance is you're buying life insurance for a specific period of time at a specific cost.
And term insurance is exactly what you get on your car.
Right. And it's what most people have through their employment contracts.
Yeah. So this is the fee for a year. I pay this. And if I die during the year, this is how much get paid out.
Right.
And we are not here to tell you which is better.
Right.
I have definite opinions on that, but it's not the purpose of this show. The purpose of this show is to say, okay, do you have life insurance? Do you need it?
Assess the need yourself, whether or not it makes sense. I mean, the whole life has had some kind of there's been a bit of a renaissance the last couple of years. I don't know if it's justified either.
And yeah, I mean, I'm not a big fan myself, but
right.
But regardless, why would I need life insurance? Well, if I'm dead,
yep.
What do my family need? So what would be a classic example where life insurance would be a good idea?
Well, the probably the best single example is mortgage on the house. And so you can buy mortgage insurance, which I think is a horrible idea, or you can buy a life insurance policy that will be more than sufficient to cover out whatever balance you might have. And I'll give you the difference. So mortgage insurance, they pay out the mortgage when the individual dies. And so every year, the amount of coverage you're actually paying for declines.
Because you're paying down the mortgage.
That's right. But you're still paying what you've been paying all along. The life insurance, there's actually a residual benefit. So let's say you've got to buy a house with a $500,000 mortgage and you've paid it off. It's down to $250,000, but you bought a $500,000 life insurance policy when you got the house. So now not only is the mortgage paid off, but the residual goes into your estate for the benefit of your beneficiaries.
Yeah, and I think what you have to self-assess every year is, okay, so if I die tomorrow, what happens?
Right.
And if the answer is, well, my spouse and I, we're both working, we're both contributing to the mortgage payment, I'm dead, well, now my spouse doesn't have my income to contribute. How does my spouse keep the house and the kids and right. all the rest of it in it? Okay, that would be a pretty good example to have life insurance that pays out the mortgage.
Right.
So then it becomes a math question. How much would it cost to go to a life insurance place and buy a $500,000 policy in your case?
Right.
And how much would it cost to get it through the bank?
Mm-hmm. And you could buy declining insurance, life insurance over the years, so it becomes a less and less expensive thing if you wanted to. Most people don't.
Well, and that's something to assess, because I guess if I'm 80 years old and all of my house is paid off,
right.
do I really need life insurance if I got money in the bank? And of course, for an 80-year-old, life insurance is expensive. Mm-hmm. If I'm 25 years old, okay, the insurance is less expensive and there's more of a need.
Right.
So I think that's really the point we're trying to make here. Assess what your needs are, what you're paying, and every year or two reassess, does it still make sense what I'm doing?
Yep.
Now, that's life insurance. Category number 2, medical insurance or disability insurance.
Right.
So the obvious question there is, does your employer have it?
Mm-hmm.
Because if they do, okay, how much do you get? So if I become disabled and can't work, how much do I get?
So a typical employee relationship is that if you become injured or somehow aren't able to continue working, you go on short-term disability first. Often that's for 6 months. It's somewhere between 2/3 and 3/4 of your income. Most places then you switch over to long-term disability after that 6-month period, and it's somewhere between half and 2/3 of your income, depending on the policy.
And obviously there's medical insurance through EI.
Yep.
So what you want to do, again, is look at the worst case scenario. Okay, if I become disabled, I'm not dead, so my life insurance doesn't kick in, but I'm disabled, I can't work. What coverage do I have? What do I need?
I still have bills to pay. I still have to be able to do month-to-month things.
And if you're self-employed, well, obviously you don't have it through your employer, so should I be getting some other type of insurance?
Right.
I've switched employers. I had a plan at my old place. What about the new place? So it's, again, assessing what your needs are. Third category, asset insurance, like car insurance, for example.
Or homeowners insurance.
Or homeowners insurance. Okay, again, kind of a no-brainer.
Well, the car insurance is legally required, at least for liability issues. So if you're in an accident, the individuals that have been injured, yourself first and then others, there's insurance to fall back on. Whether or not you actually insure the physical car for replacement is a decision you got to make.
So that's collision insurance.
Right.
So if you have a brand new car with a loan, they're going to require that you have collision insurance.
Correct.
If you drive a car like I drive,
which is not brand new.
Which is not brand new.
Which was not brand new 10 years ago. Which was not brand new. How many?
It's got 250,000 clicks on it.
Right.
So, okay, if I did smack up the car, how much would it cost to replace it or fix it?
Right.
And if the answer is, well, okay, it's a $5,000 car, then do I want to be paying X number of dollars a month on insurance?
Right.
So again, we're not telling you what to do. We're just telling you to.
And that's a much bigger issue for young people too, folks. I mean, young male drivers under 25, the insurance costs them more than the car.
Yeah. So it's
different conversation.
Something to consider. And then the final category of insurance, credit insurance.
Oh, yeah.
Ooh. So you got a credit card and the bank says, oh, no problem. We can put, that's a bad example. Well, it's a good example, but an even better example would be these loan companies.
You have a high interest loan at a second tier lender and they say, well, we'll get you payment insurance if something goes wrong. And I can't tell you how many people have told me, well, when something's gone wrong, they were disallowed the insurance for some reason.
Right. So if you lose your job, we cover the payments, or if you get sick or whatever, and the insurance premiums are really high.
They are.
Like it's not 12 cents a month. It's a lot each month added on to your loan. And then you're right. Then I don't qualify when I do lose my job.
Yep. Now, there's nothing wrong with the concept of credit insurance. Just don't buy it from the company selling you the credit. Get yourself a term life insurance policy or something.
Yeah, or a disability policy. These are the two
all
things.
These other things. That's right.
We just talked about. So, okay, so the point on insurance is figure out what could happen, what you need, what you're paying, and go from there.
And what you can afford.
Exactly. Okay, category number 3, investments. So what we're talking about is your annual checkup. Every year I kind of go through this list and see what I need to do. And what we're going to do in the show notes is put timestamps so you can skip around if you want to go ahead or back. So I've got investments. The first question I think would be, do they still make sense?
What kind are they?
What kind are they?
Right.
So let's say I've got some bank stocks.
Okay.
And bank stocks for the last 150 years in Canada have paid dividends. You're
going to get somewhere between 4 to 7%.
They've been a good investment. Now, maybe you think we're heading into a massive credit crisis and therefore bank stocks aren't going to perform as well.
Right.
Okay, well, it's not my job to give investment advice here, but if you think something has changed, well, maybe it means your investments have to change. I think a more basic question would be, okay, so I'm going to be saving some money next year. Do I put it in a savings account, a TFSA, an RSP, or what?
Right.
That's not something you're going to think about every single day.
Right.
But as an annual thing to sit back and look at it.
So part of this annual process is also looking beyond the next 12 months. So for instance, I got 3 teenage kids. So at some point I had to start saving for their educations. They're now getting to the point where I'm not required to make those or even allowed to make those contributions anymore. So we have to look to the next tier of things that they're going to need.
Yeah, once they hit 16 or 17, whatever it is, you're not contributing to an RESP anymore, but the kid isn't 18 yet. They're not at university yet. So, okay, do I put the money in a savings account? Do I put it in a TFSA? What do I do with it?
Right.
And most people have competing objectives because I want to save for my kids, but I also want to save for a car and I want to retire someday.
Right.
Where do I put that dollar?
And it's going to be a different answer for every person based on their unique situation.
Yeah. So that's why you got to think about it. And it may be that, well, I was saving for my kid to go to university, but now my kid wants to enter a trade program. Fantastic. That's
right. To make a better living.
Highly recommend that because we don't have enough tradespeople. Okay, so maybe the RESP is less of a big issue. Maybe I shift the money somewhere else, whatever. So again, it's what has changed in the last year and what do you think is going to change in the future? And I want to talk about interest rates, but let me go to number 4 on the list. Bank accounts.
Right.
I got a story to tell you.
You found one you didn't know you had?
Yes. So we tell all of our clients, we strongly recommend when you file a proposal or a bankruptcy, open a new bank account at a new bank.
Right. Close the old one.
Why do we tell them that?
Well, so the banks have something called the right of set-off. So when they get notice that you've filed a proposal and you've got money in a savings account and you owe them on a credit card, they legally have the right to take the money out of the savings account to apply to the credit card first.
And if you have a line of credit with the bank where they're taking of the monthly payment every month, when you file the proposal, it takes time for the bank to be notified and turn that off. I can almost guarantee they'll be taking the next payment out next month without stopping it. So we tell everyone, open a new bank account at a new bank. Now, this is a bit of a sidetrack, but do you recommend that the average person watching this show have more than one bank account? In other words, a bank account at your main bank and then a secondary account. What's your theory on that?
Depends on their level of discipline. So if you're not very disciplined and if you have all your eggs in one basket, so a checking and savings account at the exact same branch institution, and you know that anytime you put money in the savings account, you're just going to take it every month, then there is some benefit to having an account someplace else so that you don't have easy access to it. You can't just reach in and grab the money.
So out of sight, out of mind is what you're saying.
There you go.
So, okay, so I want to start an emergency fund, and I'm going to put $50 a month into it, and that'll cover, if I need to buy a new pair of boots someday or whatever.
Right.
So if I open a brand new bank account at a completely different bank and put it in there, it doesn't show up on my app every day. I don't see it every day. It's tucked away.
Well, an extension of that conversation is if you do find yourself getting squeezed because of your debt servicing, at some point it makes sense to have your paycheck and your regular day banking someplace different than where you carry the majority of your debts. It's convenient to have everything at one bank, and the banks certainly want to sell you that because it's good for them too. But if you want to have complete control over where your money goes, bank someplace other than the majority of your debts are carried.
Yeah. So you have your debts at one bank, you have your assets at another.
Right.
Is what you're describing. And it could be because you get into trouble and your cash is tight. It could be that, I just forgot to make that payment this month. I don't want them automatically taking it out and leaving me short somewhere else.
Right.
So if I've got it in two different places. Now, you mentioned the word discipline originally, and you got to be careful. If you've got two different accounts now, I got to keep track of two different accounts.
Right.
And where's the money going? And my paycheck goes here, and then I got to put it here.
And a bigger problem, if you're no longer keeping your day-to-day banking at your first bank, when you go to get approval on new credit, it may be more complicated because, why don't you bank here?
Yeah, if I'm going for a mortgage, the bank can look at my bank account and go, we see your paycheck has been deposited every 2 weeks for the last 5 years. We know exactly what you make. We don't have to verify your income because we can see it going in. Same with a car loan or whatever. We talked about investments earlier. Well, if you've got your investments at the brokerage arm of the bank, it's really easy to be transferring money, like making my TFSA contribution or whatever. So I think there are some good ideas, good reasons to have two banks. Another one would be technical glitches. What happens when the bank has some kind of service outage and you're trying to pay for your groceries with your debit card, which happens once every couple of years? Well, if I got another debit card, another bank, boom, no problem. Okay, so that's the setup.
Okay, now what are you up to?
So I am like every Canadian in that we never switch bank accounts.
Right.
Okay.
No, whatever you get it when you finish high school, that's where you're going to stay forever.
So
unless there's a problem.
Exactly. So when I opened my first bank account, I think I was 7 years old. My parents took me to the bank. Which bank did they take me to? How did they select?
The bank that they've always dealt with themselves.
The bank that they dealt with. Exactly right. So I think in our town, there were only one or two banks and it was a short walk from the house. But yeah, that was the bank my parents banked at. So that's where I went. And then when I got married, I switched to a new bank. Why?
Because your wife was working at the bank.
Because my wife was at that bank. And so, you start with your parents' bank, then you go to your wife's bank. That's how it works in life. So in my life, I have had two bank accounts at two banks. Okay. Now, we already said that we tell our clients you should open a new bank account at a new bank.
Right.
So a few years ago, I thought, well, I'm giving them this advice, but I've
don't
never
do it myself.
opened a bank account.
Right.
So I should actually know how to do it. I mean, I can't imagine it's that hard, but
I think I did see where this is going.
Yeah. So I said, okay, I'm going to open two new bank accounts. I'm going to open one at a big bank and one at a virtual bank. So for the big bank, I picked the bank that our company banks at.
Makes sense.
You know who it is. If they want to sponsor the show, we'll mention their name. Otherwise, no free advertising here.
Right.
But we've been there for 25 years. I figured, okay, no problem. I walk into the branch and say, I'm Doug Hoyes. Hoyes Michalos, we got a lot of money on deposit in our trust accounts. And they say, we don't know who you are. Come back tomorrow when you can meet with a rep. Fine. Went back, opened an account.
Right.
For the online bank, went online, opened it up. You had to do the verification, whatever. But I understood how the process worked. And at both banks, I set up a checking account and a savings account.
Okay.
Because why not, right? And I thought, okay, I will put a bit of money in both of the savings accounts because these are their high interest savings accounts.
Sure, 1%.
And that way it will be my, emergency fund. So great, I did that. So then earlier this year, I get a letter from the virtual bank saying, hey, dude, you haven't used your bank account in forever. It's now become inactive. So if you want us to reactivate it, you got to sign this form and send it back. Okay, fine. So I signed the form, sent it back. They send me a letter back saying, your signature on the form doesn't match your signature. I'm going, well, how could it? It was an electronic thing. I don't think I ever signed anything.
Right.
So I just ignored it until last week when I thought, well, maybe I should actually
follow up on this.
So I phoned them and I talked to a very nice lady who said, yeah, you're an idiot, but okay, no problem. We can reactivate your account. We'll send you a secret code to your phone. Boom, up and running. So I look at my history over the last year or two.
They just take service fees for 10 years?
No, because this is an online bank. They don't charge service fees, and they were actually putting the interest in my bank account every month.
Yep.
The 12 cents or whatever it was.
Right.
But they charged me a $20 inactive fee back like a year ago when it first became inactive.
Right.
And I guess had I known that when I was talking to her on the phone, I would have said, hey, can you waive that or whatever.
Did they charge you an activation fee?
No, they did not yet. I did check the account this morning and they hadn't done that.
Right.
But the point is, and I'm not going to fight with the bank because it's a good lesson. Don't be stupid.
Right.
What's the point of having a bank account if you're not actually going to take a look at it? Now, that's point number one. Now, point number two, I've got two bank accounts, both with a savings account. And so what's your best guess at the big bank? What interest rate do you think they were paying me on that high interest savings account?
Sure. Less than 1%.
Yeah, very close to zero is what the number was. Now, at the virtual bank, they were actually paying me a higher rate. And I just got an email from them today saying, oh, now that you're back alive,
we'd like to sell you stuff.
We have a special deal, 5.75% interest for any money you put in between now and December 31st. Okay.
Right.
Okay. Now, I didn't read the terms. I think that means
has to remain on deposit for a certain time.
Probably.
Or the interest rate's only for 30 days.
I think that's what it is. So I think on December 31st, the interest rate will change. Maybe that's how it works. I don't know. I don't know how it works. But the point is, you should actually know what you're doing.
Right.
So how stupid do you have to be to have money in two banks, one paying zero and one that can pay 5.75%? Pretty stupid. What should I have done? Well, obviously.
Kept track of what was going on, but.
Yeah, and I guess taken the money from one bank and put it in the other or,
maybe, depending on what the terms were.
Yeah, or bought crypto with it or something, I guess. But,
crypto again.
But leaving it there, earning zero, was stupid.
Right.
And
so you didn't lose any money.
I didn't lose any money. That's true. I guess you're right. If I put it
Think back to Nortel.
That's right. I could have lost big. But what a lot of people do who actually have savings. Mm-hmm. So let's say, again, back to my example, you're saving for, you're buying a car next year, you're going on vacation,
whatever the specific thing
I need to have a few $1,000 next year. So does it make sense, in your view, to keep track of what the different banks are doing and just put your money where you get the highest interest rate?
Only if you've got time in your hand to do that and you enjoy it. I mean, for most of this stuff, it makes, in my opinion, more sense to do what you are comfortable with. So if you are comfortable, maybe you've got, some kind of compulsive disorder that you have to check these things every day, having multiple accounts and doing, maybe that's what you like, but for most people, it's not going to work.
Well, let's say I've got two accounts.
Right.
One at the big bank, one at the virtual bank. I'm not going to check it every day. Clearly, I don't check it every year.
The question we should be asking anybody, does anyone reconcile their bank account anymore?
That's.
I don't remember the last time I reconciled my personal account.
So let's come back to that.
Yeah.
So I think, again, we're talking about your annual checkup. Well, certainly every year you should look at it.
Right.
And maybe it's a case of every couple of months, every 3 months, every 6 months, whatever. So if I actually take this deal, and let's say the interest deal expires on 60 days from now.
Right.
I guess I should have a note in my calendar that says, okay, 60 days from now, check and see if there's a better deal.
Right.
And I think if it's a case of every 2 or 3 months or every 6 months,
then you can do it.
Not that big a deal.
Yep.
So the point is, you should actually know what's going on with your bank account. Now, you talked about reconciling your bank account. What are you talking about there?
So the practice, at least when I was first introduced to the whole banking world, was you operate your checking account at the end of the month. You check to see what transactions actually went through, what checks are still outstanding, what deposits are outstanding. You're looking to see is what the bank says you have, what you actually have. So you're not going with the online balance. You're going with I know what I've spent on these other things to make sure that you don't overspend.
Now, I do a bank reconciliation for our corporate account every month.
And it takes you hours?
Well, it takes time.
Yep.
But it's exactly as you describe it. What does the bank say? What do my records say? What are the differences? Right. Oh, I forgot to record that. They made an error there. Get it all sorted out. Boom, we're good at the end of the month. Now, Nobody does that anymore.
And part of that is, of course, we all access our accounts online. So every day or every other couple of days when you're looking at your bank, well, what the hell was that transaction?
Right.
And I call my wife and say, what did you buy?
What's going on here? And she says, well, you bought that. Don't you remember? Oh, yeah, you're right. So, yeah, and I am a big believer in that. I think, and I don't know, is it every day? Is it once a week?
Depends on how many transactions you have going through.
Yeah. And I think you would look at your bank account, but you'd also look at your credit card statement. Same thing. Because wait a minute, I don't remember making that purchase.
Well, remember 6 months ago, somebody actually hacked my access card. And so, I mean, I got the note from the bank saying, hey, somebody's trying to do an electronic transfer for $5,000. Is that you? So I opened up the account, saw that they'd done that, and I immediately crashed the account by typing in my password wrong 3 times. But,
great.
If you don't have those kind of warnings, you don't check, all sorts of bad things can happen.
Yeah. So, and a bank can reverse a transaction if you tell them about it soon. They can't reverse it if you tell them, 5 months later, a year later, whatever. So, now you mentioned passwords. So that was also on my list. When you're dead, how is your spouse going to access the banking? If you're the one who goes online and pays the hydro bill every month, how is that going to happen?
And I have a file saved on my hard drive, whatever you want to call it, where my wife knows to look, that these are all the things you need to know.
There you go.
And I update it once a year.
And you have Post-it notes on your monitors, I guess, with all the passwords.
No Post-it notes. Sorry.
But yes, I think whatever you do, you should have some kind of system. There are password sharing things.
And somebody needs to know how to access it.
Right.
So it's not enough just to do it. You've got to tell somebody.
Exactly. So either have, one of these password managers or a file that they know how to access or whatever. And you have to update that file every time you change a password or else it's somewhat useless. That's why these password sharing things are good, because automatically they're updated in real time. Taxes would be another item on the list. When you're doing your annual review, am I getting all the possible deductions? Do I, have the receipts, whatever? If you're making a charitable donation, well, before December 31st is good, because then you get to claim it right away.
Immediately. That's right.
If you claim it January 1st, well, then it's going to be a year and a half before you're going to see the refund. So, making sure that you've got receipts for whatever possible deductions you can have. Okay. Final category is debt, because this show is called Debt Free in 30. So if you are doing an annual review of your debt situation, what are the kind of things that pop into your head that I should be looking at?
Well, it's an obvious picture. Have I got more debt or less debt than last year? Have I been properly making all my payments? Should I be rebalancing my debt? So I've got a line of credit with room on it that's prime interest rate, and I've got a credit card balance I've been carrying. Should I move it over? That sort of thing.
Yeah, I think that makes sense. So my mortgage, for example, well, are there prepayment ability with it?
Right.
So most mortgages, it's a 5-year term, but you can make, an extra month's payment every year or whatever.
Most of them allow you to do up to 20%.
So, okay, if I've got no other debt other than my mortgage, should I be throwing some extra on my mortgage, or should I be putting it in my RSP?
And that's a tough question. Depends on everybody's situation.
Right. You got to crunch the numbers, do the math. When does your mortgage come up for renewal? All those kind of things.
Yep.
And again, the purpose of this show is not to tell you the answer. It's to say, well, these are things to think about. If you've got a loan that's open and a high interest, well, that's something I'm going to want to pay off quicker as opposed to a fixed term loan that I can't.
Well, and part of this debt assessment, a good habit to get into is write them all down, the interest rates on each of them, and decide, okay, which of these do I want to have eliminated before next year's assessment?
Yeah, and you actually are making a plan.
Right.
And that's really what we're talking about here. I've got a plan. I want to go through boom, boom, boom. And if I've got that one loan, it's only $1,000, but the interest rate's really high. Well, maybe that's the one I really want to attack.
Right.
And because I've looked at it and I see it there, I go, okay, you know what? I am going to carve out an extra $50 or $100 every month and throw it.
Find a way to make it go away.
Yep. Find a way to make it go away. If you don't step back and look at it, well, you're not gonna have that plan. So
life moves pretty fast. If you don't step back and take a look at it,
it does.
Thank you, Mr. Bueller.
There you go. And again, we're not saying every single day.
No.
We're saying whatever it is, every 3 months, 6 months, year, whatever.
We are saying at the very least once a year.
Yeah.
Right.
And you actually set aside the time. I'm going to go through all these things. So again, we'll have a list in the show notes of everything we talked about. I'm sure there's 50 other things we could add to that list. By all means, leave them in the comments. And, it's a good habit to be in.
Yeah. Now It's an eye-opening exercise. So when you take the time to actually write down, this is what I own, this is what I owe, this is what's got coming in, this is what's going out, it gives you the power to make decisions, to make changes in a positive manner. If you wait for things to happen to you, well, I mean, that's a strategy a lot of people follow, but it's usually not a successful one.
Yeah, you don't want to find out, oh, I didn't actually have disability insurance, or I didn't have this, or I didn't have that, or my spouse is no longer here and I don't have access to my bank account or whatever. These are all things that can be solved a lot easier if you do them now.
Right.
So there you go. Ted, thank you very much. So those of you who are watching on YouTube, if you've got ideas that we didn't mention, throw them in the comments because, hey, we might as well steal your ideas. That's kind of what we're here for.
Right.
And obviously on YouTube, make sure you like and subscribe and notification and all the rest of it. Most people listen to this podcast on the audio version on Spotify, Apple Podcasts, whatever podcast thing you want. Again, subscribe, like. New podcast comes out every Saturday morning, and we will be back again next Saturday morning. Ted, thanks for being here. Until next week, that is our show. Thanks for listening. I'm Doug Hoyes. That was Debt Free in 30.